Good afternoon. Welcome to the TheoTRADE afternoon video. I am Blake Young. Today is August 7th, 2025, and we're going to continue the discussion about looking for risk-free rates of return, or what we'll consider relatively risk-free rates of return compared to bond prices and bond yields. So we have the bond yield up here at the top. This is what we started talking about in today's main room discussion, so just a little bit of a follow-up. And we have a 4.233% 10-year Treasury yield as it compares to the bonds. So 10-year Treasury yield, 4.233%. So if we're looking at this, we're saying, can I get a similar equivalent return on risk or return of premium versus the underlying price that we pay for the instrument? And as we watch the market today, we see that we're very mixed. We have utilities rising. That's a good sign for dividend stocks and bonds. It's a sign of safety or flight to safety. Basic materials are up, and technology is flat for the day, which is normally what lifts the entire market. Consumer discretionary is negative, and we're just not really seeing a lot of drive into risk-on behaviors. And that gives us a real opportunity, again, to look for those dividend stocks that will pay us out every quarter or semi-annual, even occasionally monthly, to give us a return, even if prices stop moving. So that's what we're looking for. And I want to get as close as we can to 4.23%. Now, in the main room, we've already discussed how to scan for these and how we look for dividend yields. And I'm going to go through and just show you a couple of ways to layer into 2 or 3 positions in these dividend stocks. So let's start with United Healthcare. And United Healthcare is one of the ones that meets these qualifications, that have a good debt coverage and a good yield, and are setting up for those opportunities. And the reason why I'm using this is not because it's running into bullishness. It's that we have a level of, we'll call it safety, at these low prices. So United Healthcare Group is way down at 243. This is the lowest level it's been at for the year about 3 days ago. You can look at the year from through here. And so we don't want to catch a falling knife, but we're looking at it being way down here at 242, 243. And if we were to look at the dividend yield that it pays, if we look at the dividend yield under the trade tab, you're going to see UNH pays a 3.6% dividend. That is $2.21 per quarter. The next dividend is roughly September 16th. But that's not what we're looking for. We're looking at a stock that has fallen, and can I get into this position, reduce my risk, and then collect the dividend if this is the bottom of UNH? I don't know if it is. But if it is this the place we want to start exercising options and setting up trades that are going to give us the best opportunity? Next dividend is in September, so we could probably do September 12th and get a sign, but I'm going to calculate it roughly for a month, and we're going to use the September 5th number. Now you'll note we get 775, 795 in here on the dividend versus a 243. Now, you may note that we're getting paid $7.75 to almost $8 at 240. Current price is 243. So price could fall $3.16 before we even get assigned. And we're also getting paid upwards of maybe $8, which means our cost basis would be 240 minus that $8 and bring prices down to a cost basis of $232 on United Healthcare. Is that a reasonable return? Now, another one we might look at is KMI, Kinder Morgan. And you can see we've held this support level through here. It's a nice place. If it sits there and holds sideways, is it worth enough to collect those dividends? You can see the dividends are 29 cents, 29 cents, 28 cents, 28 cents. If we roll those 12 months of dividends together and divide it by the current price, that's a 4.3% dividend. When's the dividend going to be paid? Probably October, end of October, early November. So October 31st, early November, somewhere in there. So we have plenty of time to sell August, September, and potentially October all the way through here and collect dividends if we get assigned, but collect put premium if we don't. So if we go out about 1 month again, calculating off September, we get that same 2.5% for being willing to own it. So if I could collect 2.5% per month at the money, and it goes back up or holds where it's at, we collect 2.5%, we times that by 12, and we end up getting about a 30% return on the year just selling puts. If we get assigned, then we own the stock at $27 minus the 65 cents. That brings us down to $26.35. and then we look to collect a dividend yield that's going to be bigger than 4.3 because we're getting assigned at a lower price. But then we collect that 4% and we get another 2.45%. So now we have that 6 to 7% safety net. If it just sits flat, we're going to get 6 to 7% return. If it falls, we're protected by 7%. But if it goes up and goes back up to the near-term highs, I'm not even talking about the annual highs, but the near-term highs, we're going to collect another 10% while we collect that dividend. Let's analyze two more really quickly. That is going to be CVS Healthcare. And again, I can look and say, okay, they pay a 66-cent dividend. They pay that quarterly. And stocks here in the middle. It doesn't mean that we have to be buying into this. It doesn't mean that we're looking for some massive return. We're looking for it to be stable or go up. And if it can be stable, can I get paid enough put premium to get in and enough dividend to make it worth my while to have a risk-free return for the stock? If it holds, excellent. Let's take a look. If we go to the trade tab, first thing, we have a 4.2% dividend at the current price. If we look at the dividend X date, it's 7/22, so the next one is probably 10/22. So we could do September options, and there we are again, roughly at 2.5%. We had 2.3%, and price would have to fall from 60 to 95 to 62. So here in just a minute, if CVS gets a little bit higher, then 63 would be at the money, and we're going to get 3% or about $2 at the money. I would rather go a little bit out of the money, so I'd say it's better to go for the 2.3%, pay it $1.44, and then start collecting 66-cent dividend. We could do that for September. We could do that for October. And if we did September and October, we're going to collect about $2.80 in put premium. And if we get assigned in those 2 months time frame and own it before the dividend X date, then we'll start collecting the dividend, and we're going to have that safety net of about 5% and 4%. So now we're approaching 9% between the dividend yield and the put premium that we use to reduce our cost basis. Now, the one that we're going to use last is one of the highest dividends that I had meeting my qualifications as far as meeting the right prices and having a good return on equity and having good debt coverage. And it's one that I've never really traded, but it was interesting to me, and this is going to be EPD. Now, if you look at EPD, Enterprise Prods Par, you can see it's a 7% dividend yield. In addition to that, we have a pretty flat stock, and it has been flat besides this massive response since May. We had a similar upturn and then a downturn, but you can see it goes into these holding patterns for 3, 4, 5 months, and something happens. 3, 4, 5 months, and something happens. 3, 4, 5 months. Now, we could be approaching the something happening on an earnings event. This was not an earnings event. This one was. But if we're sitting here, is 7% worth the risk? The puts on this aren't great. We're not getting paid for our risk. So if you look at the 31 strike versus 31.50, it's only 1%. If that's the case, I may just want to wait for a lower price or a bounce and just buy the stock. If the puts aren't going to pay us enough premium to justify missing the dividend potentially, then I don't want to take that trade. So 1%, is it worth it? Probably not. If I got paid 1% and I'm missing out on the dividends, because the dividends are going to be bigger than the put's going to pay me. Now, we could still do this for September and collect that 1% because our dividends aren't going to happen probably till October or November. So 1%, but as we approach that October, is probably going to be worth just buying the stock outright if we're trying to collect that 7% dividend. And that will give us 1 month at 1%, 2 months at 1%, so September, October, and then we're going to have 2% plus this 7.9%. So now we're approaching a 10% safety net if we add the dividends to the short put premium in this chart, which would mean if we hold it for a year, stock would have to fall all the way to and through the annual lows to offset the dividend we're collecting and the short put premium we got in those first couple of months. So there's lots of opportunities to create these safety nets, these low risk, high steady returns from the dividends, even if we don't get the appreciation of the underlying stock. But when things get uncertain, like we talked about with utilities doing the best, and we see technology slowing down, and we see earnings missing, when things get uncertain, there's usually a flight to safety and a risk-free return. So I'm going to tell you, I'm watching for dividend stocks. I'm watching for putting positions in bigger dividend stocks, but getting into those positions by selling puts to get a better price for those positions. And that's what I'm going to be watching for probably the next 2-3 months as we get closer to that September possible rate cut and some more uncertainty. If we don't get a rate cut in September, I think you'll see more flights to safety as we're uncertain how the economy is going to go, and those dividend stocks are going to be the high flyers potentially in both demand and the return on risk that is a relatively risk-free return on investment. That's going to do it for me today. Thank you for watching, and we'll see you again tomorrow.